Good afternoon and welcome to LBMA webinars. Today we will be lifting the lid on LBMA's 2022 Precious Metals Forecast Survey. To lead our panels, we have Nicky Shiels, Head of Metal Strategy at MKS PAMP. We have Bernard Dahdah, the Senior Commodities Analyst at Natixis, Thorsten Polleit, Chief Economist at Degussa Goldhandel GmbH. I do hope I've pronounced that correctly. And finally, we have William Adams, the Head of Battery and Base Research at Fastmarkets. Before I hand over the panelists to talk about the survey, I'm just going to take you through a quick housekeeping slide. So if you have any questions throughout the webinar, we do encourage you to ask them. You should see a questions icon at the bottom of your screen or the top, depending on which version you are using. Please drop any questions you have through to there. If you have any problems finding that, you don't know what I'm talking about, just email ask@lbma.org.uk and we'll pass those questions along to the panelists. If you are watching a recording of this, again, feel free to email ask@lbma.org.uk and we'll do the same. So Nicky, whenever you're ready.
Thanks, Taylor. Thanks everyone for joining from far and wide. Thanks to the LBMA and obviously to the panelists. I couldn't say this better, but it's, certainly a very well-timed event given that market volatility is back. Prices are breaking higher as we speak, and there's certainly renewed risks to monitor with European war basically top of mind this morning. So I'll keep this short and sweet. We'll try push as much relevant information as possible about the current markets through to you guys, but we also want an open dialogue. So please, as Taylor mentioned, please just utilize the Q&A for all precious related questions, and I'll try to sprinkle them in as we just work through what's going on. So so as Taylor briefly mentioned, these are the analysts, our panelists that have largely stuck their necks out with regards to their forecasts. They are either largely more bullish or more bearish than the collective group of the 34, I think, research analysts who contributed to the LBMA survey. So this group, call them the street, the 34 analysts, collectively have an average price forecast for gold of 1802. That is probably about as neutral or boring as a forecast as you can get, given that we're stuck at 1800 for about 18 months. Notwithstanding the last 3 weeks of strong repricing. The top 3 influences identified by the street for gold prices in 2022 were, it was inflation, it was the Fed, and it was equity market performance. And geopolitical tensions weren't deemed an important driver. And I think that just highlights how fluid the markets are, given we certainly playing a little bit of a sort of like headline ping pong right now with the Russian and Ukraine headlines. So, on our panel, we have Thorsten, who represents the most bullish outlook. He has a potential high of almost $2,300, and Bernard, who has a relatively bearish outlook, giving a potential price low of 15. So, I think I'll start off with Thorsten. Given that gold is up $180 on the sort of war risk. You talk about in your outlook, you talk about the Fed basically being behind the inflation curve and keeping real rates negative for as long as they can for a key driver for your higher gold price outlook. So given this recent rally, we're well through at $1,900 now on geopolitical risk premium. Can you outline more of, are you more bullish now than before? And just can you walk us through a bit of your outlook?
First of all, thank you very much, Nicky and Taylor, for organizing today's webinar. It's a great pleasure for me to be part of the effort. Well, the investment case for gold and silver, from my point of view, is the following. The inflation beast is bigger than you think it is, and that the prices for gold and silver haven't yet fully adjusted to this new reality. I wouldn't be surprised, and you just mentioned my forecast, basically, if the price of gold will reach $2,100 per ounce at the end of this year, and the silver price will reach $28 per ounce. So when measured against today's price action, gold has an upside potential of around 7%. And if I consider the upper end of the forecast price band, of 16%. So that's quite sizable and attractive, I think, from the point of view of many investors. And the upside potential for silver is, I think, around about 11 and 23% respectively. These numbers do not factor in the Ukraine-Russia conflict, and I will say a few words about it at the end of my hopefully very short remarks. Still, key to my story is the fact that, as you all know, consumer goods prices around the world are rising sharply, and people are debating basically two questions. The first question is rising price inflation temporary or permanent? A few months ago, many people thought elevated price inflation would be temporary, that it would return to normal soon. Today's consensus is, I think, that price inflation will remain elevated for longer than previously expected, but will eventually return to acceptable levels of around 2%. Is that reasonable expectation? Well, this brings us to the second question. What is the cause of this kind of price inflation? Most mainstream economists usually point to the impact of the politically dictated lockdown crisis, production halts, logistical bottlenecks, etc., and green policies, which they argue have been driving goods prices up. While this is undoubtedly true, an important inflation driver is overlooked, I think, and that is the excessive increase in the quantity of money. To give you an example, the US Federal Reserve has increased the money stock M2 by 40% since the end of 2019. In the euro area, the ECB has raised the M3 money stock by around 20%. And this, in turn, has created an enormous monetary overhang that is now translating into higher goods prices, both consumer and asset prices, such as housing and stocks, etc. To cloud the inflation outlook further, money growth rates have remained very high. Now, you may say central banks have announced that they will take action and will take their foot off the monetary accelerator. But will it be enough to dampen price inflation? I don't think so, because central banks are faced with a delicate trade-off. Bringing down price inflation would require substantially higher real interest rates to rein in credit and money growth. This, however, would presumably put the debt pyramid in the global financial system in great something that is politically highly undesirable. So I think central banks will likely be less harsh when it comes to curbing price inflation. Price inflation, I think, will most likely be higher for longer, while real interest rates will remain lower for longer. So the financial repression will be extended. The future normal inflation, I think, can be expected to be between 4 and 6% per annum, potentially even higher. And once the inflation process has started, and I think it has started, it is relatively difficult to stop it for political reason. And so there's reason to conclude that the inflation beast is bigger than you think it is. And I think it's important to remind the investor that protecting one's capital from inflation-related losses is and will remain a key challenge in the years to come, a challenge that requires a lot of attention in everyone's investment process. From my point of view, gold and silver are not yet factoring in, I said it earlier, in the inflation regime that is unfolding in front of our eyes. I'm confident that these metals, bought at current prices, will be both risk-reducing and return-enhancing for the investment portfolio. And as far as the Ukraine-Russia conflict is concerned, and I mentioned it at the beginning of my remarks, this development is not included, but I do not think that it will lead this conflict to something like World War III, as some people fear. However, it will certainly create an even more favorable environment for inflation. And so this should make an even stronger case for holding gold and silver. And as I said, these two precious metals, I think, have still an attractive risk return profile. And I hope I could explain how I derive my forecast, which, as you said, Nicky, is more on the bullish side. Thank you very much.
Yeah, you certainly had. There's a lot to unpack there, and you certainly hit the nail on the head in terms of inflation and running with that theme. It's interesting. We are still printing money. The Fed is still currently QE. Yeah. We haven't even had one rate hike, and we got 7.5% CPI in the US. And I do somewhat agree. I think gold and silver is what I call their stimulus peak in 2020 is in, but the inflation peak is not yet in. And I think, again, what is sort of spooking the markets or investors is the threat of aggressive policy response from the ECB or from the Fed, which is going to drive real rates much higher. And you see that in the investment holdings. ETFs are sitting at 100 million ounces, and it's not really moving. COT data that they haven't surpassed all-time highs. So my question to Bernard, who's you represent the bear case. You speak about the threat of higher rates, and if we get real rates in positive territory, that's going to unlock all ETF holdings, and that's a big headwind. How do you see that playing out? This year, especially given the fact that we got crude oil above $100 as we speak?
Yeah, so from my perspective of looking at the things is that when it comes to inflation, my take on it is that it's more related to the fact that in our view, that 2021 was a bumper year. So 2020 lockdown, you get a surge in demand in 1 year supply. There's a supply shock, and the supply can't keep up with that demand, which had been locked up in 2020. So that, in our view, is the main explanation behind the surge in inflation. So going forward, as demand normalizes and the supply chain normalizes, we'd expect for inflation to still at high levels. We see inflation at 5%, but we don't see it like US CPI. So I don't see US CPI, which was last month at 7.5%, rising to 8, 9, 10, 11. It's more that it's a gradual decrease in that speed and growth. At the same time, we think that the Fed is going to raise rates, that the ECB is going to follow suit, that BOE has already done it. So the question is here, at what speed will the Fed be raising rates? Today's news probably changes the tempo in terms of how aggressive maybe the Fed will want to be in terms of raising rates, given that we still have to see how long that conflict is going to last. Is it going to create a commodity crisis? Does that mean that there's a price shock and that we need to leave rates for lower? But from my rationale at the time is that basically rates rise, inflation kind of normalizes, real rates start going less and closer and closer to the positive territory. So we get kind of a cool off of gold prices. So even putting my forecast at 1,600, still very elevated. I'm not expecting a crash in the price of gold as per se, as we saw back in 2013 when we saw a massive outflow in physically backed ETFs. But I do think that the holding of gold and physically backed ETFs, although it's very positive source of demand, usually in those circumstances, can quickly shift into source of supply. And this is where I think the big risk is. The other thing also I would mention is when it comes to inflation, I think the story this time with all the money that's been put in is that, like as was the case in 2009, those were policies, if you want, that were targeted at the mainly real estate, benefited maybe the real estate market and the equity market. So inflation really, if you want, explodes in that case if that money was targeted at just credit consumption. Okay, so I think that's the difference, is that since 2009, I mean, there was some helicopter money given the extreme lockdown measures that were put in place. But generally speaking now, I mean, with the rates having remained low and the money that was put in, it was more about targeted towards real estate markets. And we're seeing possibly we're seeing a real estate bubble and an equity market bubble, given those huge amounts of money. But I wouldn't go as far as saying or being concerned that this is like a massive credit consumption that everyone is going to be able to buy left, right, and center. That's not where the money went. Yeah, that's I mean, my perspective. But I've become a little bit more bullish, given the latest developments. I wouldn't be surprised to see obviously gold rise to 2,000 over the next few days, even. But I do think come the second half, or once the situation calms down, we could see a correction in the price of gold. Just because if you look at previous conflicts, if you even looked at the attack that we saw on the Saudi Arabian oil facilities, we see spikes in the price of gold, but we see quick corrections once these situations kind of calm down, basically. So I wouldn't expect that gold prices would keep on benefiting once the Ukraine story settles one way or another. Now, if there are sanctions put in place on specific commodities, then that's a different story. But I don't think we're going to see sanctions put in place on commodities, given how much Europe relies on imports of commodities from Russia. We're talking about 63% of Europe's nickel consumption coming from Russia, something like 14% of aluminium. So in terms of sanctions, on commodities that would backfire. We saw that with the Rizal story. And in terms of weaponization, we will touch on Palladium later on. Also, long-term cost on whoever weaponizes, because you see diversification of the chain, of the supply chain.
Right. I mean, both of you touch on, sort of investor demand and the just huge amounts of like systematic liquidity that's entered the system. And, there's some stats out there, but last year there was something like over $1 trillion flowed into global equity funds, which is more than 25 years combined. And again, like I highlighted, ETFs sitting either side of 100 million. Gold and the precious metal sector just hasn't seen huge amounts of subscription. Whether it's COT or ETFs, it's flowing into real estate, like I said, it's equities, and perhaps other commodities. What either one, all three of you, or the panelists, I mean, what do we need to see to get investors really re-engaged in the precious sector? Do we need more inflation? Do we need more fear or war? Do we need better marketing? Do we need a recession? What is that trigger? Because we're seeing it somewhat in prices now, but we're not seeing it in the flows.
I think, if I may, Nicky, on that, I think we are starting or in a sort of commodity super cycle, and I think if you look back into the early 2000s, there are a lot of similarities between now and then, and I think although that might drive the sort of industrial metals more, I think we saw back then that it also carried gold with it, and I think in a sort of a rising tide lifted all boats in that thing. I think we've also got, as people have mentioned, you've had very buoyant equity markets. You've got a bond market which now faces rising yields, so that could get into trouble. So we could see some rotation out of the equities and bond markets into the precious metals, I think, and into commodities generally. So I think that's certainly a factor that we could get sort of further lift from. Right,
and also this idea that you vaccinated the world, all commodities, precious metals, from energy to ags and base metals, sort of reflated up with this reflation theme. But now we're starting to talk. I mean, certainly now the key theme is around stagflation in Europe, because you've got $100 oil, you've got a war on their borders, and it puts the ECB in more of a bind than the Fed relatively. And I think you see that very strongly in gold and euro pricing, which is absolutely repriced super strongly today. And as a sort of stagflation hedge or a war hedge. So I guess, Thorsten, back to you. You're in the thick of it. How are you seeing physical demand in Europe, and how, we talk about general sort of more paper or leveraged investor flows, but the physical side is very important. How are you seeing that play out and respond to this?
So there's a pretty strong demand for physical material. It's not many investors, even entrepreneurs who put their cash reserves into physical gold. That is something I saw in recent months. It's pretty unusual. So people do not put their money into gold ETFs or gold ETCs, but they look for physical stuff. That has changed against in previous years. It was a different kind of flow we saw, and personally, I encourage people to opt for the physical material, because the risk profile is different from, let's say, an investment in a gold or a silver ETF. For instance, you don't have a counterparty risk if you hold physical material, or you are not depending on trading hours, etc. So there are some advantages, I think, for investors who really want to hedge against the risks that the system can get a big hit at some point. But let me just mention, you mentioned, Nicky, something quite interesting. When would we see a push for the price of gold? I mean, the Ukraine-Russia conflict certainly has had a strong impact in the short run, but I think in the long run, still, it's important to note that on the one hand, I think many investors underestimate the inflation danger. I don't want to appear to be smarter than the rest, but I can tell you, amongst economists, it's no longer popular to analyze monetary data. I have to admit, I love analyzing monetary data, and what I see is an enormous monetary overhang, which is disregarded by many analysts. And so I come to the conclusion that the inflation pressure is much, much bigger than most people think. But at the same time, if investors do not fear inflation, they lower their demand for insurance against inflation. And that was basically bad for gold in the last 2 years. And in addition, central banks have put into place a safety net. Most investors assume that once a big bank, a government gets into financial trouble, the central bank will come and inject new money and lower interest rates. It's like a safety net that has been put under financial markets. People are no longer concerned about credit or default risks. And this also has lowered the demand for gold and silver as insurance against these events. But I think further down the road, people will live up to reality. So if central banks keep the safety nets in place, they will increase, they have to basically increase the quantity of money even further, and that means inflation. So at the end of the day, I think the factors are in place to push price for gold and silver further up in the coming years.
Right.
Just following on from that, I think, you've also got a lot of infrastructure spending which is coming along. You've also got this huge move to electrification as well. So I think, as well as a lot of the monetary inflation, I think there is that sort of real need for these raw materials and things like food as well. I mean, China needs its more raw materials. It needs more food as well. So I think we're going to get inflation from lots of different angles, plus also wage inflation.
Correct. No, I mean, there is inflation coming from us from all metrics, whether it's food inflation, energy inflation, wage inflation, sort of asset bubbles, which is asset inflation. The question then is just, it kind of rolls into the longer term thing. Is gold the preferred inflation hedge? Because there is alternative inflation hedges. It doesn't necessarily need to be gold. For certain investors, it is. But for me, I think 2022 really is a make or break year for precious metals and for gold, because you've got record low negative real rates and inflation. It's the perfect backdrop. And gold hasn't rallied besides the last few weeks. And I think it's starting, we got geopolitics to be the trigger and the spark. But again, follow through is certainly key. And for gold to basically prove itself as a reliable inflation hedge. Because
last year was also, I would say, make or break year. But I mean, given the exceptional circumstances, you would have thought that gold prices would explode. And actually, towards the second half of the year, gold prices retreated. So right. You're right in saying, is actually gold the best hedge? Is it actually a hedge against inflation? I mean, if you look at back in the 80s where gold prices were at around 800, and you waited till 1999, it was like continuously dropping. So I'm not saying that gold is an awful hedge. I'm just saying it's not the only one. I guess one of the other problems with gold, physical gold holding, is the cost of holding it is relatively high compared to other, it doesn't give you any yield. So whenever you get real yields rising, the opportunity cost of holding gold increases. So I think that's one of the downsides, I guess, of holding gold.
Correct.
I think also last year you saw, after 2018 and 20, you saw a significant rise in gold up to sort of new highs. And I'd say last year seems to be in sort of a year of sort of consolidation to some extent. And I think people were sort of believing that the story that inflation is just transitionary, and things have moved on from there, I think, now.
Right.
Maybe, Nicky, you give me the chance to drop some numbers. As you know, the euro was introduced in January 1999, and I have been a Eurosceptic ever since. And I basically recommended gold as an insurance against the monetary policy-driven debasement of the purchasing power of the euro and other currencies.
Right.
And when you draw a chart showing the price of gold in dollars or in euro, you would show the US stock market as a performance index, including capital gains and reinvestment of dividends, and the same index for the euro area. And then you would see that the increase in the price of gold in that period from 1999 until 2022 was 8.5% on average per year.
Wow.
The increase in the US stock market was 8%. And the increase in the German stock market performance index was 5.5%. So gold in that period even outperformed the stock market. So it was.
So what if you took the point in 2010, maybe? What would it show? Yes. So that's the problem with points. Because you can always pick a point. I can pick a point.
Slice and dice it.
Yeah, absolutely. And the reason why you're absolutely right. And my argument is that over the long term, gold is the inflation hedge, not necessarily within a year or within 2 or 3 years. Gold is a long-term hedge against the debasement of the fiat currencies. That's the point I would like to make, and I'm quite confident.
I think we lost you there for a little
good
bit.
Hedge, because the international into big trouble, and you see around the world, the central banks have basically put interest rates to zero. They print money just to keep the system. This is not going to change, and so I'm quite confident that gold is and will remain in one option for protecting capital against the loss of inflation. That's what I'm saying.
No, I certainly don't disagree. I just think a lot of things need to come together. You got the backdrop, you got the super bullish supportive backdrop, but you need whether it's geopolitics, whether it's equity market volatility, but for gold, for a little more fear in the market. Otherwise, you got a debasement of currencies and a huge amount of systematic liquidity. It just benefited stocks for the last decade. So, I think things are coming to place for gold, and it's certainly going to be an interesting ride. But I'd like to just wrap it up, and we'll move on to PGMs. Just given a lot of questions coming through on Palladium, but it's Russia, we know, is one of the biggest exporters of palladium and we talk about weaponizing commodities, but just how much of a threat, I'll post it to the whole panel, how much of a threat are actual supply disruptions, given the new news, given we're looking at sort of, more sanctions, and do we have any sort of quantitative estimates as to how to look at all of this?
If I might start on that, I think obviously certainly palladium, with its, with Russia being the largest producer, I think, there is a potential threat if this drags on and if sanctions are applied. I think, in a way, we haven't seen sort of the prices react as much as we have in some of the other metals coming out of Russia. And I think one of the reasons for that is that sort of palladium's been in a fairly weak spot recently, in recent months, 6 months or so. And I think, so it's having a reaction on the upside, which is understandable. But I also think, the sell-off we saw in palladium was probably, overdone. And I think it was really triggered by concerns about the slowdown in the auto market. We're starting to see, I think we'll start to see auto manufacturers start to increase production again. I think this year we'll start to see the semiconductor shortage start to ease, and that will start to boost it. And I think you've seen a market that was very strong, obviously sold off, obviously a lot of destocking in there, and now I think with the sort of brighter prospects, plus the sort of the Russian situation, you will start to see some restocking coming in.
Correct. Yeah, go ahead, Bernard.
Yeah, sorry. On this topic of palladium, we saw a 5% increase today, 5% increase yesterday. So the question is, are we talking here about sanctions on a palladium producer, or are we talking about Russia weaponizing palladium by saying, actually, we want to reduce our export quotas the same way China did with rare earth metals vis-a-vis Japan? I don't think this is likely. Just because I think from the lessons we saw from Rusal is basically it backfires. So if they put on sanctions, the Europeans are going to hit themselves. I mean, palladium is only 0.4%, palladium sales is only 0.4% of Russian GDP, whereas the Europeans are using palladium for much higher value goods. So backfiring would hit them more. From a Russian perspective, weaponizing, between brackets, palladium, the problem with it, which we saw with rare earth metals, is that you end up wanting to look at different suppliers and diversifying away. And like Japan did, they used to be 90% reliant on Chinese rare earth metals. Now they're only 50%. So I would suspect that with palladium, we'll see a rally. So people are nervous. We're seeing that rally, but I doubt that we're going to see weaponizations or sanctions on palladium. Titanium is an interesting one, just because Russia is also a massive producer of the metal. Maybe that could play more there because it hits directly weapons. But again, the problem with weaponizing those commodities is that eventually the person buying just wants to diversify away in the long term.
Right. No, that's a good point. Whether it's halting supply of weaponizing commodities, and especially, to the fact that a lot of these commodities are politically important. You're talking about transitioning, the energy transition, strict emission regs. There's no real substitutes for rhodium, palladium, and platinum in an ICE vehicle. And we have stronger, EV penetration rates, but we're not there yet. So it really is a sort of an interesting topic to work through.
Yeah, and when it comes to sanctions, I mean, sanctions are a complex instrument, and one could imagine that Russia is then selling. I mean, if the international community does not unite in imposing sanctions against Russia, we could imagine that Russia is selling palladium to China, and China is selling this stuff on to other countries, and it may become more expensive to obtain palladium. But I could really imagine that sanctions are not really an effective instrument in drying up the markets for platinum and all other metals that come out of Russia.
On that point, like, it's interesting what you say, Thorsten, because China introduced, I think, a law last year saying, basically, grosso modo, saying that local Chinese companies aren't allowed to comply with foreign sanctions. So as opposed to when the US put sanctions on Rusal and some of the Chinese companies were like, okay, I'm not touching any more Rusal. This time, actually, by law, they're not allowed to do that anymore. So it'll be interesting to see if there's going to be, if China turns out to be the market of last resort for Russia, and the US putting sanctions, let's say, against XYZ company, and a Chinese company saying, actually, you know, we can't do that anymore, and we're just going to keep on buying. What happens then? You know, also going forward, you know, you start thinking, you know, with the reaction of the Europeans and the US, or lack of reaction so far, does China start rubbing its hands and looking closer at Taiwan? You know, they're it's another question. I'm sure they're looking out very closely at what's happened, at the reaction of the West vis-a-vis Ukraine, to see what they can do themselves.
Yeah, I mean, absolutely. I think there's a lot of questions around this idea of like sort of copycat wars, or just, you know, the US as a sort of global power has certainly retreated. And I think, you know, that was sort of marked by the Afghanistan withdrawal last year. And it's, you know, it creates a more multifaceted world, and geopolitically, it becomes a lot more tense and uncertain. And I think, obviously, you know, that speaks more to gold as a safe haven, but also this idea of just, you know, bifurcated markets where you're dealing with rogue states, or dealing with rogue states that sort of through off-market channels, and it really, you know, plays through in commodities in a big way. I think so. EVs, William, you're obviously, this is your focus, and I just wanted to touch on it. We have a few more minutes, but basically, we've got, you know, I've looked at China new energy sales, and that, you know, the big bear case for Palladium was, you know, faster EV penetration rates, and, you know, you've got China at 13%. I think US is only something like 3%, and we're clearly the laggard. But when do you see the US playing up, and what is that tipping point for mass adoption for EVs? Because I think that's certainly a big driver for the big Palladium bear case that investors are looking at.
Yeah, I mean, EVs have really surprised, haven't they? The sales since sort of COVID first struck, we've really seen a sort of concentration of sales and really strong growth numbers, certainly in China and in Europe, and also in the US from a low base. You know, I'd say in China and in Europe, you know, their EVs are becoming much more mainstream, much faster than people probably expected a few years ago. You know, maybe when we get when the semiconductor, I mean, half the slowdown we're seeing in sort of conventional vehicles is because of the semiconductor shortages. So I think once that sort of situation is relieved, then I think we will see, you know, ICE vehicle sales picking up again. And I think that will, you know, that will boost demand for the PGMs as well. But, you know, it is for Palladium, it is going to be a headwind. I think, you know, I think overall, though, we're still going to see, I mean, we saw 6 million EV sales last year. We tend to see what is about 100 million sales. So still a long way to go. So I think it's a bit sort of early to sort of start writing off demand in for the sort of PGMs. And also, you know, a lot of the, so if you looked at Europe, it's about 1.2 million battery only vehicles. So they wouldn't have catalytic converters and things. But just over 1 million EVs were plug-in hybrids. So they have petrol engines as well. So they will still need the catalytic converters. And I think that generally the overall standards for emission controls are improving, are tightening as well. So that's going to be good as well. So I think, yeah, I still think there's plenty of room for the PGMs still to see growth in the EV market. But it is a headwind, I think. Okay, great. So yeah, just to wrap up here, I know it's sort of busy day in the markets, but I thought we'd end with a sort of either or speed questionnaire. It's sort of yes, no answers, one, you know, just no explanation, just to sort of sum up what we've talked about. So, you know, for gold, will we see 2100 or 1800 first this year? Thorsten?
Well, volatility is can be expected to remain high. And I don't have a crystal ball. I'm more confident when it comes to the longer term, let's say 3 or 5 years or longer. We will see much, much higher prices, gold prices and silver prices in particular. The more short term, I'm inclined to think that the Ukraine-Russia crisis will be relatively short-lived and that the markets will come down. So I'm inclined to expect that it's not in the coming days that gold will go over 2100, but over the longer term, it certainly will.
Okay, 21. William, 21 or 1800 first?
Oh, that's a really hard one.
Yes,
1800.
just, yeah, just
1800.
one answer. 1800. Bernard, 2100 or 1800 first?
Oof. I have to answer directly. I'd probably say 18. No, exactly, no explanation.
1800.
I'd probably say 1800 first,
okay.
Though probably very close to 2100 on the Russia story, but 1800 first.
1800 first. Okay, so we have mostly in the short term, I guess, bears 1800 before 2100. Yes, no question. Will silver trade to $30 this year?
No.
Yes. Okay. So more bears. What will come first? US inflation hitting double digits or recession? So double-digit inflation, 10% on CPI, or recession first?
More likely to get a recession. Sorry.
Recession.
Inflation.
Inflation.
Inflation first.
Inflation. Okay.
Double
so we'll
digit.
get inflation, double-digit inflation before recession. Will platinum post stronger gains in 2022 than palladium? Yes or no?
I think palladium.
Will post stronger gains than platinum. Okay, bullish palladium.
I think platinum
is the outperformer. Bernard?
Outperform palladium.
Okay.
I'd say there is more likelihood that palladium outperforms platinum.
Palladium. Okay, interesting. And lastly, central banks really didn't buy a lot of gold in the second half of last year, given historical trends, and that's when we really had inflation sort of rearing its head. Will central banks buy more gold in 2022 than in 2021? Yes or no?
No.
No. Wow. Okay, that's pretty bearish outcome if we don't have that tailwind. Well, thank you all. Thanks all for dialing in. That's a wrap for today. If we didn't get to your questions, we'll try to send out any responses. And hopefully we filled in some gaps and helped formulate some views over the market. I'll just hand over to Taylor to wrap it up from here.
Thanks, Nikki, and thanks to all the panelists for contributing in such an exciting discussion. If anybody is watching this back recorded later or following the webinar, you have any questions, do send us an email to ask@lbma.org.uk. We'll forward these across to the panelists to get back to you in due course. Moving on to other webinars and events upcoming. For LBMA members, we do have our LBMA annual party next Thursday on the 3rd of March. If you're not already registered, registration has closed, but you can send your interest in and we can add you to the waiting list. If you are registered, we do have some emails upcoming with more information about the event. So we look forward to seeing you there. On Wednesday, we launched our Sustainability and Responsible Sourcing Summit, which takes place from the 28th to the 29th of March. So emails were sent out yesterday, but if you have any questions or you need to find links, do get in touch with us so we can send these out to you. And this week, we also had our LBMA virtual training on Tuesday and Wednesday. So our next course dates will take place in June on the 9th and the 10th. Courses are already filling up. Places are already filling up on the course. So if you're interested, do let us know so we can get you registered for the training. That's all from me today, except one final thing, which I will add, is that Our member survey report was released today. If you do want to know any details about that, please head to our website where we have that updated, so you can read about it. I think that is all from me. Does anybody else have anything to add? I don't think that you will, aside from a final goodbye to our lovely attendees.
Thank you.
Great,
Thank you very much for the
Thank you very much.
invitation. Have a great time.
Thank you.
Thank
Bye.
you. Bye.